So, when it comes to credit scores, there's always been some long-standing myths and just misunderstandings of what the real truth is and how things work when it comes to credit scores. You've seen things in the news, or when you go to the bank, they'll have banners on the walls talking about interest rates, credit scores, credit karma when you do your taxes, things like that. So, I'm here to tell you that the set standard rule for you got to have X amount for a credit score is wrong. Okay, there has been some changes lately, specifically when it comes to conventional loans, and I'm gonna get more into that. My name is Chris with Equity Real Estate, and I help first timers in the Pacific Northwest. And so the recent change I mentioned talks about is more specific towards the conventional loans. That used to be where you had to have a credit score of 620 to get a conventional mortgage, excuse me, and so if your credit score was below that, they would just kinda tell you, "Hey, sorry, it's not gonna work. We can't help you," and they would, depending on the bank or the lender that you're talking with, they would kind of just, maybe slough you off or, they wouldn't really be much more help than that. And so that's obviously not what we want and what's good for customers. So the there's also other loans than the conventional loan, but the reason that that change has happened is because they're taking more into account. The change occurs kind of on the back end of the loan side from Fannie Mae, which is on the secondary mortgage market, as a security. So the change comes from being able to look at a whole mirage of inputs. So they're looking at a more holistic view instead of just one, using one key item to kick you out. They're going to look at the whole piece pie instead of just one, instead of looking at the crust, so to speak. And if you didn't make it past the crust, you don't get the pie. So some of the things that they're looking into, versus just that one credit score, is overall income stability. Do you have a stable job? Typically, they want 2 years of, same job history. If you had a job for a year and then you get, a promotion, obviously that's with the same company typically. That's good. That can be fine. It doesn't have to be, the same role exactly, no changes whatsoever. Promotion is always good. That shows that, you're working your way up the ladder, so to speak. And then if it's kind of a straight one-to-one transfer, for example, if you're a teacher and you go from this district to that district, or high school to college, potentially something like that, or you drive. I know one that sticks to my mind is, let's say you're a delivery driver for a bakery. Let's say Fran's Bakery here locally, and then you get a job working for Tillamook Creamery and you deliver cheese and dairy products all day, ice cream. If that maybe that's what you do, you run a specific route. Okay, great. Those typically are not large enough changes where it's going to say, oh well, that restarts your 2 years and you've got to restart, and that becomes this whole hassle. That's typically not a problem. So there's the income stability, like I mentioned, overall debt to income ratio. So do you have a large auto loan? Do you have multiple auto loans? Maybe last year you bought a boat or a jet ski or a travel trailer, whatever it may be, ATV, depending on what you like to do, your hobbies, things like that, and your lifestyle. So if you have a lot of expenses, that can be a problem. But again, that's going to probably affect your credit score anyway. So the payment history also has a large input, because as a mortgage is probably going to be one of your biggest payments, and they wanna make sure that, "Hey, can you make the small payments? Because if you can't make the small payments, it's probably gonna be tougher to get you to make the big payments," and that's a concern for the bank and the lender. So, they also look at overall assets and reserves as a total. So, as I mentioned, kind of the boat, jet ski, scenario like that, that doesn't necessarily count for those types of things. The bank doesn't necessarily see those things as, real big collateral items. Assets as in, do you have other real estate? Do you have a business? Do you have other assets, stocks, bonds, other financial instruments or things that are of value? Collector baseball cards, typically don't work, or a collection of baseball cards or whatever it may be typically doesn't work, but obviously, there's specific items that might be, a Babe Ruth baseball card that's worth, thousands and thousands of dollars. Maybe that might help. That's kind of a specific scenario. But that's just things to keep in mind. And so although the change is good in my opinion, and I think most people think it's good because why not look at people and, and as a whole instead of just a credit score, right? That's kind of the thought. So overall, it's good. However, I think people can imply or believe that it might be a bigger change than it really is. This isn't necessarily just kind of like a blank check, and all of a sudden, okay, it doesn't matter what your credit score is. They're not going to look at your credit score anymore. They're not going to care about any of those income stability assets, things like that. They still very much do care, and they still want you to have, prior credit built up, right? If you've never had an auto loan or a credit card or things like that, it still can be difficult for you to get a loan. Um, if you have a good job and you've been paying your rent on time and all your other uh, costs, then yeah, you're gonna have an easier time. But it's not just, oh, they got rid of the 620 credit score, so you can just buy whatever you want and get a mortgage, without any implication. Obviously there's going to be limits on that. So it's still really important to have stable jobs with good credit history, things of that nature. So it's not going to take away from those things. Like I said, it's not a blank check. Every lender will have specific, kind of guidelines that they follow and things like that. So just because one says no doesn't mean another one will say no, depending on what it is. If you don't have a job, they're all going to probably say no. If it's just, comes down to certain ratios and things like that. Sometimes some of them have more, they're able to kind of provide more leniency and flexibility on certain things. One that we kind of run into sometimes can be like travel nurses. When they get a contract, they're a nurse, but they don't necessarily have 9 to 5 for the next 5 years lined out for them. Let's say at Providence or Kaiser or something more local. So they're going to other states for 3 to 6 months, and they make really good money. But then that contract ends, and so then they might have 1 month off after that, and so that can kind of be difficult. There's other ways to get around that and to kind of mend the gap, so to speak, but it can still have an impact. And so, what else is really important for people to think about is that 620 credit score that change was just for conventional. Most other loans, that was kind of like one of the most strict, credit barriers there were in place. FHA, VA, USDA, they have typically had lesser kind of minimums, and so you didn't have to have as high of a credit score. Depending on the scenario, FHA can be kind of 500s to 580 could be the minimum. It really depends on the exact scenario and some of those other things. Again, if your credit score is 520 or 550, 580, but it's trending up because you're starting to pay those bills, you're starting to get back on your feet, so to speak. Maybe you had a car get totaled or you had car troubles and you had to replace an engine or something like that, you missed some work, so your hours were down, then the car payment and the bill for the repair got put on a credit card, that didn't get paid for 6 months, so that kinda dinged you. Now you're on your way back up because that car is fixed, you're going to work every day, you're doing what you're supposed to be doing. So and if it's trending in the right direction, you still can potentially get approved for a loan that'll help you buy a house. Obviously, that's good. So, things to think about with that is, not every down payment has to be kind of the typical 5, 10, 20%. That's another myth that people have. FHA is a very good option, and we've been seeing a lot more FHA loans typically in the last year, 2 years, specifically because the inventory's been higher, so having an FHA loan versus a conventional loan, there's been less bidding wars overall, so that means that the buyer has more flexibility in what they use to compete with, and the reason that FHA loans can be better for buyers, the rates are usually a little lower, and which that in turn means that the monthly payment is a little lower, so, that's typically the best case scenario for the buyer, and the down payment amount is typically less as well with that 3.5% standard FHA. So again, there are different variations of these things. USDA and VA might have certain requirements for credit minimums and standards. They also both are zero down options. So those things make a difference, and that is credit scores. Kind of overall right now That's been the recent changes as of November 16th, that 620 credit score removal, that minimum was removed. So again, they're not going to be looking at that specific number as much. Okay. They're still going to be wanting to make sure that you have credit. And, at a certain point, your credit score is reflective as you as a borrower. So if your credit score is low, they might not just kick you out because of the low credit score. It might because you have, 5 years of, kind of missed payments and, high debt and, a lower income, things like that. So, the credit score is built for a reason, although they're getting rid of that one kind of kick out clause, so to speak. So, I hope you've liked the video. I hope you've learned something. Please like and subscribe down below. If you have credit questions, feel free to add them in the comments. And as always, subscribe to get more information about buying and selling in the Pacific Northwest and other news and updates about the market. Thank you.